The following is a production of Texas Lutheran University. For more information, please visit tlu.edu.
We are very fortunate to have Donald Yacktman with us today. My students have been bombarded with numerous Don Yacktman interviews, transcripts. They study your portfolios on a regular basis, and I think they've already learned quite a bit about you, but we thank you for being here with us today. A little bit about Don's background. He has a BS in economics from the University of Utah. Maybe provided a little motivation to get Ron Huntsman out of his rocking chair to join us today. Also has an MBA from Harvard, and he has been a portfolio manager as long as I've been alive, and has had his own firm just about 20 years now, and has done exceedingly well with it. That said, turn it over to Don.
Thank you. It's good to be with you. And I just turned 70. My compatriot here who has a few years on me. That's not many that I've run into now, it seems like. But seeing a couple of us older guys here reminds me of the story of these two fellows who were chatting with each other. And the one fellow said to the other one, he said, my memory is really starting to go. And the other one said, well, I was having trouble with mine too. He said, but I went to the doc and he gave me some medicine. And he says, it really seems to be working. Just can't remember the name of that medicine. Flowers, bushes, thorns, red, yellow, and white, and pink. And the other guy looked at him and he said, Rose. He said, that's it. Rose, what's the name of that medicine? So hopefully I haven't reached that stage. But anyway, I'm happy to be with you. It takes a little while to get down here, a little longer than I thought. I thought I'd have about 15 minutes, and it took a little longer with a little bit of traffic. They got a new on-ramp in Austin where you can get off of 290-71 to go straight onto 35. The only trouble is it's backed up at 3 o'clock all the way back to 71. So it takes a little while for it to integrate. I can just imagine what that looks like at rush hour. Anyway, what I want to talk about a little bit, you sound like you've had a lot of chances to study a lot what I do. So what I thought I would do is I brought some material. What I really want to do is get the big, important concepts across. And a lot of our business is a function of really getting the right things and having some patience. I think one of the biggest things that differs between us and so many people is our horizon time. We just have a very long horizon time, and most people just aren't very patient. I mean, I think there's, when you realize that the market fluctuates about 50% a year from its low to its high, I mean, not the market, but the average big company does. And you've seen the cost of trading continuing to go down. But I think it creates an incentive for more turnover rate. And as a result, like our turnover rate in our mutual funds is about 20% a year. This year it's well below that, but part of that is masked because we've been getting a lot of money coming in, and as a result of that, all you have to do is not buy, and you buy something, but you don't buy something else. So it sort of is a way of backdoor selling, and it doesn't show up in the statistics. So it's a little deceptive. But I'd say realistically, it seems like on average we're about 20% a year, maybe higher when the market goes through violent swings, and lower when it is less volatile. And I think the average mutual fund now has like 100% turnover rate. There's a guy in Boston, I think it's about 500%. He's a wild man. Anyway, I thought I'd put this down. It's what you buy and what you pay for. That, to me, that's really ultimately what this business boils down to. We're not efficient market theorists. We love those that believe that because it creates opportunity, and we're happy that there are some people out there who accept that. By the way, one of the problems with that is that readily admit that if you took all the mutual funds, for instance, and you put them all together, they in effect create the market. And so when you find out that 70% of mutual funds underperform an index fund, I mean, that's sort of like saying the market's underperforming the market because it has a higher fee structure. Well, mathematically, I mean, that works, but that doesn't mean do not look for the 30% that can do it over time. The dilemma in this business is, I think, really to demonstrate it takes like 10 years. And after 10 years, most of the portfolio managers have changed. One of the unique things we have is that I have a son and another partner, Jason Sabatke, my son Steve, and the three of us really running the funds and doing most of the investment process. It's unusual that you have that kind of continuity. So, I mean, he's 41. He looks like he's about 20. He's, his wife has had 3 embarrassing times where they've asked if they could help her son. So, that's not what you say to a woman. But he runs like 50 miles a week, so I mean, he's got about a 32-inch waist and crop blonde hair. So that's because I married a blonde, and the Swedes tend to look younger anyway. I had the same problem with my wife, but having had her called, he called my daughter, asked about my daughter a few times. Anyway, one of the benefits of that, by the way, is when you go to the amusement park and they try to guess your age. She never lost, just to give you an idea. Anyway, let's move on. These are the 3 goals that we have in our methodology. One is not lose the client's money. In other words, we don't mind short-term fluctuation losses, but we want to, every time we make an investment, it's with the idea that we're going to make money with that investment. And I'll give you, there are some exceptions where we recognize that there's probabilities in this business, but we really try to avoid a permanent loss of capital. What I mean by that is, as companies get what we perceive as more volatile potentially, or the outcomes are varied, we either take it and buy them at a deeper discount to what we feel they're worth, or buy a smaller percentage in that particular stock, so that's the way we control risk. The second one is make equity type returns. That means double-digit type returns. We're shooting for that kind of thing. And number 3 is beat the index over a full market cycle. Market cycles vary. That's why we said if we use 10 years, that will include every market cycle. So that's how we come to 10 years as an arbitrary number. It's always good to point out a few numbers, and these go through September. As you know, that quarter was a pretty wicked quarter. October we lagged badly because the market zoomed up. That's very typical. This year's kind of unusual because this year has shown a lot of different type of market environments. When you had this kind of slow, steady rise, we tend to kind of hang in there, so to speak, in a period like that. So the first 6 months we kind of hung in there. Then the market got pretty choppy, and we just dramatically accelerated our relative performance. And then now the market zoomed up real quickly in 1 month, and we tend to lag. So that's very normal for us, and that's the kind of thing that tends to happen. I'm oversimplifying and overgeneralizing, but that central tendency occurs. We obviously we're not going to beat the market every quarter. We're not going to beat the market every year. We're looking at the long term, and the numbers, because most of them are longer term. In fact, I just got our board book today, and it was kind of interesting because, like, we're in I think for every time frame, we're in the first quartile, and I think we're now, most of them are in the top, like 1%, most categories, except for the short-term stuff. But you can see over a long period of time where the numbers really stand out. And one of the challenges is that we have is that right now we're kind of like king of the hill. And so, as I keep telling people, be humble. There's only one way we can go from here. And it's not on a relative basis. I do think, though, that the process stands the test of time. By the way, before I ran and set up my own company, I ran another mutual fund for 9 years, Selected American Shares. Selected American Shares, first 6 months was a balanced fund. After that, it was an equity fund. And over that 8.5-year period, it was like number 5 in the country. So I'm not telling you that to brag, because trust me, in this business, you're always wrong. You don't buy everything at the bottom, you don't sell everything at the top. So get used to it and just recognize that, it's just minimizing the errors, so to speak, is what really counts. But the process does work. I mean, I think, again, you've got almost 30 years now of history. I was certainly 29. Our firm will have been in existence 20 years next year. Okay. This happened, I just pulled off from the website our top 10 holdings, and this is the fact sheet. You can see the kind of things we own. What's unique about this, some of these are the things that a lot of the more pension consultant type people like to look at. By the way, beta is a better measure of volatility than it is risk. Risk is losing money. But I've been in this business over 40 years, and what's unique about this period of time to me is that I cannot find another period of time where there are so many what I would call great businesses, very profitable, large international businesses selling at prices this low relative to other things. Not absolutely. Absolutely in 08, 09 period, they were cheaper, but on a relative basis, to me, they're very, very cheap today. Which reminds me of one of my sons, another son, who now has his own company, Yacktman Capital Group. He has a good record too, but he's working with a lot smaller group of clients and so on. But anyway, when he was much younger, he said to me after dinner, you can imagine in our home we have 7 children, but dinner, and by the way, I told him before we had any of them, I had a full head of hair and none of it was gray. So they love me for that. But anyway, he said to me, he said, Dad, he said, let me see if I get this right. He said, what you're basically telling me is if you buy above average businesses at below average prices, that on average it's going to work out. And I said, yeah, that sort of sums it up, son. So this business doesn't need to be overly complicated. A lot of people, I think, make it way too complicated. But you'll see, most of you know what these companies do. I mean, Pepsi and News Corp, Procter & Gamble, Microsoft, Cisco. By the way, Microsoft and Cisco, somebody had told me 11 years ago that those would be 4 and 5 as our largest holdings. I would have laughed at them. Microsoft sold it more than twice where it is today back then, and Cisco, at a price it was recently, it still is less than 25% of where it was sold at. And at one time it was down to 80%. So, I mean, just amazing what happens over a period of time. Coca-Cola's, I remember in 1998, Coca-Cola sold as high as $89 a share. We bought it about 5 years later, at less than half of that. And yet, it's almost every year the earnings and dividends went up. So, I mean, it's just amazing to me what happens in this manic depressing thing we call the stock market. Cisco is a Houston-based company, by the way. That's the one that does services, McDonald's, and a lot of those places. It has a 7% market share. But in that business, that gives an enormous cost advantage. And I hardly can see Pfizer and Johnson & Johnson.
Yes.
And U.S. Bancorp. Yeah, U.S. Bancorp is not a typical bank because it's U.S. Bancorp has a lot of fee revenue as opposed to spread revenue, and that's a lot better business. All right, I'm going to talk now about kind of some other things. Let's talk about, this just happens to, That's just another picture of the same thing. Whoops, that's the other fund. That's, okay, now let's get to the fun part. Okay, desired investment attributes. And these are the three parts we're going to talk about. We used to have a logo of a triangle, which I still think my son says, I look at it a little differently, Dad, so we took the logo off and we just said it's easier. Let's just talk about what we do and leave the logo off. But I still think in those kind of terms, but I recognize that the management side is reading out, and I'll talk about why it's important. But I mean, it doesn't fit that first quote about it's what you buy and what you pay for. So let's talk about these three things, though. The first one is it will focus on is the rate of return. Then we'll talk about the good business, then the shareholder-oriented management. Okay. Jason has this phrase, it's almost always about the price. The key variable in buying stock is the price at which you buy that. That will determine the rate of return. I want you to conceptually think of stocks, not as stocks for a minute, but think of them as bonds. And think in terms of yield to maturity when you think of bonds. What we've done is basically tried to do this. We've said there are really four component parts that make up an investment rate of return if you look at it over a long period of time. You lay out capital here, but then you get cash, and the cash is basically every year you get cash. The cash flow, the free cash flow really, or adjusting for some minor things, but let's just talk in terms of cash flow. That basically falls into two categories. One is the one you receive, and that's called a dividend. You know exactly what that is when you buy stock, and you can figure that very precisely. You ought to be able to figure out what your rate of return is on the reinvestment of that dividend based on your historical experience. You also know the other part of the cash flow that's left over that's not being paid out in the dividend. And you ought to be able to gauge at least the first years relatively carefully and reasonably. The real tough part is looking at the cash flow that's going to be reinvested by the management over a long period of time in a series of investments and seeing what kind of rate of return they're going to earn for us. So we'll come back to that one. That's the third part of the triangle, so to speak. But in effect, what you're doing is you're estimating cash flow and the growth rates of those cash flows. And Steve, Jason, and I all were directors of a public company, 1-800-CONTACTS. They sold contact lenses over the internet now. They started out with the phone number and so on. And as a result of, by the way, this company, when we invested in it, was doing about $1 million of volume back in 1996. We loved the business model. Steve and Jonathan Kuhn, who's the CEO of the company, had gone to school together. Jonathan had started the company in college. And Jonathan was just a great marketer, but he needed some capital. And so we invested some. 2 years later, the company went public, and 9 years later went private, and probably soon will be gobbled up by Walmart. They have an option. But it's now the biggest seller of contact lenses in the world, by the way. But by being on the being directors of this company, and Steve spent time almost as like an unpaid consultant to them, they really have had a chance, and we've all had a chance to see a company on the inside as well as the outside. And I think it does make a difference because ultimately you're trying to bring to bear your business acumen when you make the judgments which have to go in, because nobody can predict the future with accuracy. I mean, nobody's that smart. And what I would tell you is when you're looking at growth rates and all these kinds of things, there has to be a range of outcomes. And depending on the volatility of the business model will determine how wide those outcomes are. But ultimately, you're boiling it down to trying to create what we call a risk-adjusted forward rate of return. In other words, we look at the rate of return going forward, then try to adjust for the risk. We perceive the risk as a function of the volatility of the cash flows, which could be a result of operating or financial leverage or other events. So we'll come to that one now. We'll talk about businesses. This is an oversimplified graph, but what we have found is that there's a centralist tendency for the better businesses to earn high returns on tangible assets. That's one of the reasons we like 1-800-CONTACT. That's one of the reasons why Pepsi fits that pattern. And businesses that have high returns on tangible assets usually have a low fixed asset component, and they have they have very little economic sensitivity. So let's go to the top holding and talk about Pepsi, which fits that to a T. And as a result of that, coming back to the concept of the risk-adjusted forward rate of return, we're willing to own a huge amount of Pepsi, over 10% of our portfolios in it, because it's quite predictable. And at these prices, we're saying we're going to get those double-digit returns, and we don't have to take much of a risk. Now you compare that, I mean, just to give you the extreme, I may be telling you that treasuries are overpriced today, but you can get a yield on Pepsi higher than you can get on a 30-year U.S. Treasury. So you get, and they raised the dividend 7% earlier in the year to give you an idea of what they're growing at. So overly simplistically, you're looking at a double-digit return, just adding the dividend growth and the dividend. And by the way, we're not enamored with dividends. I'd rather see the company be more creative, but that's a problem for a lot of these profitable companies, because dividends are a derivative of cash flow. So cash flow is really critical here. Anyway, if you put these businesses here, you'll see Pepsi hits that corner where it has low capital intensity, low cyclicality. Conversely, we'll go either direction away from that, recognizing what we have. If you go to News Corp, you're moving more toward economic sensitivity, but low capital requirements. And News Corp, the biggest component of News Corp today is Fox News. And Fox News today is bigger than CNN and MSNBC combined, growing nicely and moving more toward a fee-driven model away from an advertising-driven model as they move into the cable area, or they get their cable fees raised. On top of that, you got Chase Carey, who had been at DirecTV and run it, and came to be number 2 behind Rupert Murdoch, and knows the cable business very, very well because of DirecTV being an effective competitor. But we'll move the other way, which is toward businesses that have more capital, and I use utilities there as an example. Those businesses, as you move down that ladder, they tend to have to raise their ROE, or get a higher ROE because they have a low return on assets through leverage. So they put debt on there. That's one of the reasons that we don't like banks particularly. They have a very low ROA, return on assets, and they have to leverage the balance sheet, and therefore they become very vulnerable to certain kinds of behavior. And I don't know if they give you a history lesson on that. All right. What we rarely do is buy businesses that have enormous capital requirements and enormous cyclicality. And I guess the classic is to add up all the earnings of the major airlines all the way back to the kitty hawk and see they've lost money. That's a pretty ugly business to be in, and it's hard to make money in that business. So why fight it? I mean, unless you have an unusual situation, but it takes about $1 of capital to generate 60 cents of revenue. That's not a good business model, in my estimation. So we're trying to look at the business model, understand what it is we're owning. Not only the price, but what it is. And again, looking at that degree to which economic events changing will affect the cash flows of the business. The more the business has steady cash flows, the reason I think that you get these high return on assets with these steady businesses is because they can run the machinery 24/7. I mean, if you think about Pepsi's business model, you've got Frito-Lay, which is the biggest component. And anybody goes to H-E-B or any other grocery store and you look at the shelf, I mean, what do you see? Frito-Lay, the aisles dominated by Frito-Lay when you go to the salty snack food aisle. And, you know, the other parts, I mean, the carbonated beverage business may be peaking and not, but it throws off a lot of cash. They did buy back the bottlers so they can control distribution and push more product and different products through that. They have Tropicana, they have Gatorade, and Quaker Oats. So anyway, great business model. Now, shareholder oriented. This is the uses of cash. And one of the reasons this one, like I say, is the toughest one to deal with, because you're dealing with human beings and you cannot always predict behavior. I mean, who would have dreamed that Hewlett Packard would go out and spend $10 billion to buy autonomy? I mean, that one was off the charts. I mean, as an example of behavioral patterns we kind of took off. I mean, we hedged it because we were worried about their behavioral pattern, but kind of like got the double whammy when they announced that and they were going to spin off computers. But there are 5 basic uses for the management to do with their cash flow. The first one is to put it back into business. And one of the things we've learned is that if you put the business, or you put money back in the business and you have a dominant position, marginal unit growth will yield enormous rates of return. The marginal rate of return on incremental investment is enormous. Typically, a company that has a 40% market share does not make twice as much as a company with a 20% market share. They'll make 4 times as much. So that's why that dominant market share is really important. And when a company gets it, they can lose it, but somebody really can't take it away from them. It's just too difficult. I mean, think about Procter & Gamble has been making Tide for decades and been around for over a century. And they have a 50% market share in detergents. I mean, how would you like to compete with that? Okay, I would. So I mean, that's an example of what I'm talking about. So R&D, marketing, cost reduction, distribution, anything like that, that is a very good use of cash if you can protect the crown jewels and grow. The problem is most of the companies after their infancy generate excess cash. And so they have to examine 4 other options. And one of those, next one would be acquisitions. And actually I keep track of it. I'm going to tell you a little story about one of the parts of Pepsi now. Years ago, I also was an investor in Quaker Oats Company. Quaker Oats is really I think is a crowning example of both extremes in acquisitions. The problem in acquisitions is sometimes the egos get in front of the economics. The economics are right. In other words, if there's synergy and they don't overpay, they can be really dynamic. But let me give you an example through Quaker Oats of the 2 extremes. Back in 1982, Quaker Oats bought Stokely Van Camp. And I think it was 82 or 84. Anyway, they bought it in the early 80s. Stokely Van Camp had sold off their canning vegetable business. They kept Wolf Chili and Van Camp pork and beans. They had some food chemical business, a couple $100 million, and they had one little product called Gatorade that was a regional brand at the time. That's what they wanted. They basically, through the years, sold off Van Camp pork and beans and Wolf Chili and sold off the food chemical business and basically slimmed it down to Gatorade. Gatorade's worth billions of dollars today. It turned out to be a spectacular acquisition as they saw how they could take this brand to national and international levels. On the other hand, in the 90s, they thought they could do something similar with Snapple. And they had missed Snapple. They tried to buy it. Thomas Lee had bought it ahead of them. And because they didn't pay up at that time, so they really paid up later on. They paid about $1.7 billion for it, and they ended up losing $1 billion because it didn't fit. They couldn't get the distribution to fit. They found out Snapple sold coolers one at a time as opposed to on the shelf like Gatorade does and Pepsi is, and so on. So it turned out to not fit what they had hoped, and Bill Smithburg lost his job as a result of it. But that's an example of both extremes, I think, if you will. Great acquisition, and one that we had some synergies, but not enough, and they way overpaid for it. The third one is buying back stock. That's really kind of more of the same. In other words, it's like doing number two, except that you know the business. At least you ought to, and you ought to know what it's valued at. So that can be an effective use of cash. A lot of managements don't like it because it makes the company smaller, and they're always thinking. See, one of the problems with managements is that the more assets they manage, the better their salary is. So their goals sometimes don't line up as well as they should with shareholders. We vote against every option plan, by the way. Never voted for one. Because they're bad news for shareholders. They send the wrong signals. It's a terrible way to compensate. This is a classic case of where politics enters in and overrides economic behavior, and it shouldn't have ever happened. The fourth one is paying a dividend, and the tax rates being as low as they are now, that's a decent use of cash. And the last one, just sitting on it or having it pay down debt. So those are the basic options. Now, I don't know if I have any more on there or not. That's about it. I think that's it. All right. That's pretty much a summary of what we do. And as I said, ultimately, think of what we're doing in probability terms. Come back to what my younger son, one of my younger sons said. Each of those things that we've talked about today, what you're doing is you're shifting the probabilities in your favor. By buying, being disciplined, and buying at low prices, you're shifting the odds in your favor. And by one of the things that makes us different is by looking at forward risk-adjusted rate of return. We can compare a stock with a bond or with a building, for that matter. Anything that has value is ultimately a function of its cash flow, or it's the cash you can receive from it, and discounting it as you go out in time. So we think that that's a more objective way of looking at things rather than putting a price target and then trying to discount from that target. This allows us to go across the board, across companies, all the way around, and just be more objective. The second part about the business, if you have better than average businesses, again, you have the odds in your favor. And the third one is the management. Usually the better businesses attract the better managers. And so if you got a better manager, he doesn't have to be a rocket scientist. All he has to do is business 101. Back in 2002, and I'll finish up with this example. There were three companies that looked like three peas in a pod. WorldCom, Enron, and Tyco. And everybody thought they were all going down the tubes. Well, we looked at them and said we had no interest in Enron, no interest in WorldCom. They didn't make any sense to us. But Tyco was interesting. That one tweaked our fancy. Kozlowski, who was the CEO of the company, had done some bad things. He ended up in jail. And we knew he was on his way out. But we also looked objectively and said, this man has bought a number of pieces that make good sense. And you had decades of history on the component parts that you could look at and examine and evaluate. And so when the stock got down, starting in the teens, it came down from 65 to 18. We nibbled, and then at 12, we bought a full position. And this is, again, one of those cases where just a very simple back of the envelope example was all you needed, because looking at it, this is, again, I've talked to you about discounted, they're looking at forward rates of return. In this case, wasn't even that difficult. All you did look at it and say, hey, the company was earning between $1.50 and $2.50 a share. Now that put it way in the 20s category as far as we were concerned. And we didn't know which one exactly it was going to be. We thought it was pretty much near the middle of that. But at that price, it didn't matter. You didn't have to do a lot of investigating. At that price, you just started buying. And there were 2 days it went below 10, and we were probably the major buyer those 2 days. But what had happened is, and allowed it to get to there, is people threw it in the same position as these other two companies, which were trash. And they didn't really look objectively. And then the value buyers had started buying it, and by the time it got down to low teens, even the value buyers were up to here. And some stocks are what I call vomit stocks. I mean, they're just like people just don't want to see them anymore. They just want them to go disappear off their portfolios. They've seen them so long, just like Microsoft and Cisco, they just don't want to talk about them anymore. And so that creates opportunity. And it's sort of like when the storm comes through the orchard and shakes the trees and fruit drops the ground. You can easily look down and pick them up, and you don't have to pick them all up, just the good ones. But conceptually, let me leave you with one other concept. What we're doing is like pushing beach balls underwater, and the water level is rising. Now you can hold them there temporarily, but the longer you hold them with the water level rising, eventually when you take your hands off of them or whatever's holding them down, the ball's going to pop, the beach ball's going to pop. And the higher the water level, the more the rise is going to be. So patience and objectivity are really the watchwords of this business. With that, let me open it up for questions, and I'll stay as long as I can. I've got 2 grandchildren. They're having a birthday party tonight that I found out about after I committed to you folks. And, so I'm happy to be here. What questions do you have? Yes, ma'am.
What's Tyco selling for now? What's Tyco trading at now?
What's Tyco trading at now? That's a tough question to answer. We because it's split into 3 parts, and I haven't followed all of them. Covidian, which is the more interesting one, is like I don't know where it is now exactly, but it was like in the high 40s, hit over 50. But if you look at the 3 component parts and added them together, you'd have about a 4-for-1 gain, probably, I'm guessing. So it worked out to be a very, very good investment for us. But just to give you an idea, another way to look at it, and again, I'm giving you how we look at things. Covidian, which was part of this, had 25% operating margins, and at the time we bought it, it was about half of the operating profits of the company. So that's what intrigued us. And then the company went out and bought it, brought in a manager. We said all he had to do was business one-on-one for the next 5 years. He didn't have to make any acquisitions. Green had worked with Motorola. They brought him in, and he basically did that, and I think he gets decent marks. And the first thing he said, which sold me on him, was he said, I've analyzed the portfolio of businesses. Covidian is an excellent business. We're going to feed it no matter what. In other words, they're going to make sure that they're not going to, that they knew he had the wind at his back, he had a great business, or to make sure it gets the capital it needs to be the crown jewel of this company. So I mean, that to me is very important. Yes, ma'am.
Okay, first of all, I just want to say that it's my honor to have a chance to address my questions to you. And I have actually 2 questions. My first question is that when do you prefer put options instead of actual buying the stock? In which scenarios the put option come handy for you?
The put option, when should you use put options?
When is
Okay. That's an interesting question. When you manage over $12 billion, puts and calls don't mean a lot, okay? We did buy, just an example of what we did, we looked at BP when the oil spill occurred, and in the case of BP, when the stock got into like I think 27, we sold some puts on it for $3 at 20. We said in effect, if it gets to 17, we'd be happy to take it off anybody's hands, because we felt that there was enough that they could isolate off the U.S. part, even if they had to end up destroying that part of the company, and the rest of the company was worth more than that. So that was, again, we're trying to always protect against risk. My son, Brian, who has this, and I don't know if his website has any stuff on it or not, but he does some portfolio work in this area, actually, much more so. And conceptually, how I would view options are a zero-sum game. And so what I would do, and what he's done, let me just say what he's done, because I think this reflects pretty much what I would do anyway. When the stock goes down, a lot of times what he may do is he'll either buy a piece, a lot of times he'll buy a piece, and then it goes down a little more, he'll sell put. The idea that if it keeps going down, he'll be getting it even cheaper the next time around. And when the stock runs up, he'll sell a call. So in effect, what I'm telling him is, look, you're playing the house, so to speak, at Las Vegas. It's sort of like being the, and I'm not a gambler, as you can tell. I really don't. My dad, I shouldn't tell you this, but my dad was somebody. He invested in horse racing. And, I don't like odds against you, and so I refused. I saw that, and I just hate going to Las Vegas and seeing those machines there. The point I would make, though, is this: if you're the dealer in blackjack and you have enough patience, you're going to win because of the way that the whole thing is skewed. Las Vegas, in other words, if you're the house, you're going to win. Okay. To me, what you're doing when you do what he does with options is you're playing the house side, letting the gamblers, the speculators, take the other side. Now, a lot of people, the problem is a lot of people do like to gamble. That's a natural human instinct, I think, for people. And so I think that's why they like to buy the calls and they sell the puts, you know, so to speak. So as a way of, in effect, getting the extra leverage. It reminds me of the story of the guy who, 1929, he saved for 40 years, went to Wall Street, and on 90% margin, bought a few stocks, and a week later he wiped out. And he said to another guy, he said, well, easy come, easy go. It's not that way in real life, though. You know, there's pain and suffering that comes with losses, permanent losses of capital. And if you can grind it out the other way and effectively make decent rates of return, because I'm 70 now, I have the time frame that maybe most of you don't have. And that's why I just rolled over my IRA into a Roth earlier this summer when the market tanked. And that Roth, I think, has close to $6 million today. That all came from just retirement, IRA, and 401k and profit sharing, rolled over and over and over, compounded over a period of years. If you do enough compounding over a long enough period of time, and just keep moving forward. Early on, I managed Selected American. I went to the directors trying to describe what we did, and I said, think of it as a ratchet. You're just constantly trying to move forward and hold your ground. And he looked at me, and these were older guys, kind of professor guys, and one of them looked at me and he said, well, better ratchet than wretched performance. Any other questions? Yeah, you had another one?
Yeah, I have actually two more.
Okay, go ahead.
Why don't we let somebody else have a chance?
Okay.
All right. If not, I will come back to you and I'll answer after. Yes, sir.
In several of your largest holdings, you own competing firms such as Pepsi and Coke. What are some advantages and disadvantages in this investment strategy?
I think there's a guy in Omaha that, or somebody like that said too much of a good thing is all right or something like that. Pepsi and Coke are really not as similar as you think. A lot of people think that because they both have cola. You know. Coke, about 80% of their earnings come outside the United States, and it's mainly a beverage company. Whereas Pepsi is really, if they could change the name to Frito-Lay, they make more money on Frito-Lay than on Coke. What we do is we have some rules that we kind of, 25% limitation on an industry. It's kind of our rule. And, but we will stretch that sometimes, like in 1993, remember when they were originally going to pass healthcare legislation back then, a lot of the pharmaceutical companies were a lot less mature. They had great pipelines and so on. We had between pharmaceuticals and what were considered hospital supply companies like Johnson & Johnson, which is a stretch, we had like 33% in those areas. But I mean, we had Pfizer, we had Glaxo, we had Merck, we had Johnson & Johnson, Abbott, Bard, on and on. I mean, we loaded them up. But so, but again, the key is it's not the key is number one. You want to be sure you have the right thing. There's no substitute for knowledge. So it's important to study and understand what it is you're buying. But conceptually, think about it as a bell curve. And what you're really trying to do is stay in the tail of the bell curve. And one thing we haven't talked about, I mean, over 50% of our assets are in our best 10 ideas. And the higher the percentage, the better we like it. So when we have Pepsi at 10 and News Corp at 10, that's telling you something about where we feel about those companies relative to other things out there on a risk-adjusted basis. So, I mean, you know, when we post them every quarter, and that tells you where we are now. Are we going to always be right? No, we're not always going to be right. But I will tell you this, knock on wood. We've had 14 investments in 14 years that were over 10%, but we have not lost money on any of them. So we try to be very careful. We're not perfect. Nobody can get it all right all the time. Yes, ma'am.
Obviously, there are opportunities in emerging markets out there. Do you take advantage of this?
Yeah, that's a good question. Emerging markets. We actually have kind of a maybe to some degree we push there because of, but mostly it's because of where the market is today. Like I said, these large companies really fit that pattern. If you think about the world economy and you look out over 20, 50 years from now, I think the great businesses will have to have two components. They'll have to have an investment in the United States market, 20 to 25% of the world GDP, depending on what year you're looking at, but is U.S. And so you have to, in order to get your cost curve down, you're going to have, and if you're going to deal in a worldwide competitive marketplace, you're going to have that volume. The other thing you're going to have is another leg in the growing markets, the less developed markets, because you're going to get more unit growth in there. But there will be risks entailed with that. And so if you look at that list, come back to that list of companies that we talked about. Well, this happens to be, let's go back to the first one. But I mean, if you look at that list of companies, I mean, that's loaded with companies like Coke, 80% is outside the United States, maybe domiciled here. You know, you can go on and on. I think the only one that probably doesn't fit that pattern, two of them maybe, U.S. Bank and Cisco, because they're mainly here. I mean, if you look at the rest of those companies, and they're international and heavily international, but they are domiciled here. We would take that. I mean, we've looked from time to time. Some years ago, we bought a big chunk of Henkel, which is a German chemical company. But we liked two of their investments in the United States, as it turned out, and we thought we were getting them so cheap that we'll take Henkel instead. One was Clorox, the other one was Ecolab. So they eventually sold their Clorox back to Clorox, so that's why we ended up with Clorox now instead of Henkel. But I don't care where they're domiciled. I mean, we like that component. And I think all things being equal, we'll take the less risky, which will generally be that big dominant company. Because it's very hard. It's very hard to kill a company that makes $1 billion a year. It really is. I mean, look at BP or look at some of the historical things. I mean, Union Carbide many years ago in Bhopal, and on and on and on. One guy that did it was Bill Farley when we took over, and we have investment in that. That's how I remember. There's one of my losers. Fruit of the Loom. Fruit of the Loom, I didn't think you could do it, but what they did there is the company moved offshore in production because of the changes to GATT and allowing you to import more T-shirts, underwear, clothing, and everything. So he farmed it out originally, and that worked, and then he went back and he got rid of John Holland, and that was a mistake. And the other guy came in and he blew the production, and they ended up in bankruptcy. That's pretty hard to do when you have a 40% share of the T-shirt market. I mean, that's really incredible in the negative sense. Any other questions? Over here. Oh, yeah, go ahead.
Thank you for being here, and I hope we haven't gotten you in trouble with your family.
No.
Birthday gathering.
No, I warned him. It's from 6 to 8, so I said I'll be late.
Okay. You favor, or you're discouraged from going after highly capitalized, highly cyclical companies. If the market prices them in such a way, would you ever consider those companies to be undervalued and go into them, or is it just something you're not going to go no matter what the market price is?
Forever's a long time. Yeah. We actually in the focused fund, we actually have part of it's a matter of the way the prospectus is written. We weren't sure that we could do this in the Yacktman fund. So the focused fund, which is normally the Yacktman fund, anything in the focused fund is in the Yacktman fund, not the other way around. The focused fund's even more concentrated. 75% will be in the top 10 plus cash. So it's really, and that's where all my IRA is, by the way, is just for open knowledge, is in the focused fund. We have an investment in Toyota Industries. Now, Toyota Industries owns Toyota stock as well as a bunch of really grubby type of forklift and other things. I mean, just kind of some grubby stuff, and it's a small holding now, but it was very cheap. And Toyota is a much more profitable auto business than GM. I don't know. I still can't understand why people bought GM stock the second time around. I mean, what banker wants, just leave it alone. I mean, look at. I mean, the pension liabilities and some of the other things that there. I mean, I don't want to get into politics, but so let me just say, if they got cheap enough, yes, we would consider. Yes, we would consider. We actually own some like USG. We own some furniture brands. We own a couple of housing stocks over the last few years. In most cases, what happens, I will tell you what tends to happen, because a lot of these businesses have very slow growth. I think of them conceptually as moving sidewalks as opposed to escalators. But if you buy them a low enough discount below the escalator, yeah, but what happens is you get the one-time revaluation, you better move on. Whereas with an escalator, you're constantly having to compete against this rising target, and that's what we like. So in all these cases, the ones I mentioned, we bought them, we made some money, we moved on. We bought a few banks. We had some Barclays, but these were in most cases small holdings, tiny holdings. Once TARP came in, we actually had some Barclays. I think we made it 3 or 5 times our money in less than 30 days and moved on. But it was a small holding that didn't mean much, frankly. So, that's just the way we think. Yes?
What is one company that you're looking to add to your portfolio today?
Well, just look at the top 10. If you look at, we've now reported for the third quarter some new ones. And if you want to look at news, the one that we bought that I think is intriguing, an area to look at is actually our business, money management business. The one we picked out, but we only own it in the Yacktman fund, is Janus. But Janus, part of it is we can't buy a lot of it because we're so big and it's not real big. But the money management business is a very profitable business, and we looked at about a dozen of them. And the other one we bought just recently, the third quarter, was Avon. But we bought a small holding in it. In both cases, they're small holdings. So, again, I would tell you, if you want just look at quarterly, look at our top 10 and look, and stay at the top 5, and if you want to invest in individual stocks, but buy them when they've been beaten up a little bit too. I mean, like News Corp this summer, the Murdochs had to appear before Parliament. They raked them over the coals. The stock came down, and we thought we kind of got a bonus out of the deal because number one, the stock came down, and number two is because of this, they couldn't overpay to buy the rest of B Sky B, which is a very profitable piece, but they wanted to buy the rest of it, and instead they had to go in and buy their own stock back, which was cheap enough that we thought that was a much better use of cash at that moment in time. And so we kind of thought we got a bonus out of the deal, and we added to it as a result of the stock being down temporarily because of that. So look for news events and think of basically what we're doing. Again, another way to look at it is we're buying big, profitable, out-of-favor companies. And when the headlines are really negative on a company like Hewlett Packard, you know, when it got down to the low 20s, we added to it. After that bad news, we added to it. But we still are not willing to put a huge position in Hewlett Packard because we didn't trust the management. They did have an upgrade with Meg Whitman, I think, got rid of the deal. And I mean, sometimes we'll even own them in spite of the management. I don't want to be quoted on this outside this room, but my son said once we were talking about, and Steve is a little more blunt than I am, to say the least. He's absolutely brilliant, by the way. I would hold him against anybody, even Warren Buffett. But he said, now I am starting to lose it. Steve Ballmer, he said, I wouldn't have Steve Ballmer manage my son's lemonade stand. All right, you have some more, yes?
What's your take on aerospace industry as far as Boeing, Lockheed Martin, things like that? Is it risky or is it a sure bet?
That's a tough industry, the aerospace industry, to call what's happened in my lifetime. I have this economic corollary, I call it, that competition left unabated will lead to oligopoly. And you've seen it in aerospace, you've seen it in banks, chemical companies, drug companies. In other words, they shrink. And you're seeing it in roll-ups, what are called, you know, like in the garbage hauling business or, you know, whatever. I mean, a lot of service businesses gradually are consolidating. I mean, clearly Boeing is a premier company. The problem you have, the problem I have with those kind of businesses is that, you know, again, if you got them cheap enough and they were out of favor enough, I'd be willing to venture there. They are premier companies. They have, in a lot of cases, they have huge market shares, whether it's that or a Deere or a Cat or a Ingersoll Rand. I mean, to me, they all look very similar. They're all big kind of companies where it's not like toothpaste where you figure if you blow it on one tube of toothpaste, it's only $1 or $2. You know, you blow it on an airplane, that's a big investment. So, you know, that ability to sell a premier product is worth something. Sure it is. The problem is the life cycle. Look how long an airplane lasts. You know, and a tractor, I don't know exactly what the life of an average airplane is, but I'll bet it's close to the same as a tractor, which is 17 years. Well, man, that's a tough business, I think. Now, you maybe say, well, you get implements, and you get, you know, moving over to other things. But it's true that Cat and Deere and Boeing and Ingersoll, they have great market shares. United Technologies with Otis Elevator and so on and so forth. So it's just a tougher way to make money. But if you get them cheap enough, yeah. Yes. I guess we got 2 or 3 of them. Go ahead.
Warren Buffett is kind of saying, you want to learn from experience, but you want to learn from other people's experience when you can. What is the best advice that you have ever received in terms of value investing?
What is the best
The
advice?
best advice that you have ever received from value investing?
Early in my career, this goes back more than 30 years ago, I used to I read like things like Money Masters and books like that. I'd read about famous investors. I also did the same with people I felt were entrepreneurs, great managers, try to look at, see their habit patterns. But recognize if you're gonna do this on your own, as opposed to buying a mutual fund, or in effect farm it out to a professional that you feel comfortable with, then you need to ultimately stand on your own 2 feet. And inevitably, at some point, you have to go out and venture and actually put some money on the table. And but the more you can learn from others' errors, the better off you are. That's what I keep telling Jason and Steve. I said, look, one of the things hopefully I bring to bear is not, is having 10 or 15 years of wandering the wilderness out of the way, so you guys don't have to do that. But I'll tell you, if anything happened to me, our firm would go on just brilliantly without me. Frankly, these guys are just tremendous investors on their own right. And I just happen to get the accolades. They make me look good. But I guess those are the things I would say. The other thing I would say is a life skill, and it was interesting because Brian sent me an email yesterday on this, and he said, Dad, did you realize that one of your comments is really from the scriptures? And he referred to Philippi, and about, in effect, about not looking back but looking forward. My comment is usually you can't rewrite history. Okay, so number one, you'll learn more from your mistakes than you will the winners, because you'll rehash them, even though I'm saying that. But the second thing is, don't beat yourself up. Just say you're not going to do it again and move on. And I think that's true of a lot of things besides investing. Yes, sir.
You mentioned earlier you saw the decreased cost of trading is having an impact on the market environment. Are there other recent developments that you feel could be affecting the fundamentals that we're used to?
Well, the other thing that's happened that I think has increased volatility is like for instance, them taking away the uptick rule, which means you can short without having to wait for an uptick in the stock price. However, I mean, stocks are going to get to their own gravity level and so on, but I do think that and all of the electronic trading kind of things, where they're trying to find nickels, ways to squeeze out a little bit because of some pattern that they look at and so on. These are really sophisticated speculation to me, not investing. But I think that all the things that are there probably encourage that. Now, as an investor and a long-term investor, one of the other things I've said is, look, there are certain things in life you can control, certain things in life you can't control. Don't worry about the things you can't control. It's fun to talk about politics, macro stuff, the economy and all that, but you notice I haven't spent much time on it. It's fun to talk about, but frankly, if you do what we do on an ongoing basis, just continue to grind it out, it's a lot more effective and you're using your time more wisely. Just like we have a very small staff, we farm out everything we possibly can in the way of handling the details. We just do the investing, we just do the research and make the decisions. But all the back office functions, answering the phone, all those kind of things, we have somebody else do it. So, anyway, there are other things, but again, volatility is the friend of a value investor. That I will tell you. It's a friend. So, volatility does not bother me at all. In fact, I love it. In fact, we're one of the few people who probably likes to see the market go down, even on things we bought, because we'll buy more. What an opportunity. And most people just don't have the mentality to do that. And part of that is just you do it over and over again, and you get seasoned at it, and you get comfortable at it. You have some other question? Anybody else have a question before we keep going? Okay.
Value investors often get labeled as buy and hold investors. Would you consider yourself to be a buy and hold investor? And how do you avoid the trap of falling in love with the position?
Well, the question is, we buy and hold, or we fall in love. How do you avoid falling in love? I think objectivity is how you stay clear. Always stay and look at at where you are, what you own, if you own something that you bought and then things have gone against you, be objective and say, all right, like for instance, Microsoft, when they bought Skype, we thought they overpaid for it, dramatically overpaid for it. And I was quoted as using, I decided that sometimes I like little quips when I end up on TV, and I just said, it reminded me of that line from Monty Python, "'Tis but a flesh wound." Yeah, it's a little bit of an irritant, but the market grossly overreacted. In other words, the stock market sent the stock of Microsoft down more than the total value of the Skype acquisition. So what do? We bought more. Okay. We said, well, this is even a better deal now than it was before, even if you assume they flushed that whole thing down the drain. Make no money. So that's how we look at it. Objectivity, but I would say we're a limited buy and hold. In other words, we'll buy something, but gradually we'll phase in and phase out depending on the rate of return. Something doesn't abruptly change from being a great buy to a great sale. But I know that if the stock's going down and we're not buying more of it, we're a little nervous. And likewise, if the market is going up and you see our cash position building, that's not good news. The 2 times in the last decade we've been over 30% in cash, I've been very nervous and sure enough the market plunged. But we don't call the market. That's a mistake. I don't think you try to call it. What happens is cash is a residual and it just goes that way as time goes on.
The technology industry in particular seems to be rapidly changing and hard to predict. So how hard is it to determine which technology companies will work best?
The question is technology companies. Yeah, again, a lot of technology companies are early stage capital goods, which comes back to the question back regarding these premier capital goods companies that market share settled on. Let me explain what I mean. At one time in like 1972 to 4 period, I think they went from 40 to 4 manufacturers of ski mobiles. You had a period where the product came in, everybody tried to make it, and then the market shook out and you went to 4 people because you have to have enough market share to be cost competitive and make it. So that's what will tend to happen over time, and then it's when the money is made. A lot of times the technology companies make great leaps in standard of living, but the people who make the money on it is the ones who use the technology. And in technology companies, to answer your question, the earlier stage technology companies are, I guess we will probably end up avoiding the ones that are real young and the ones that are real mature. Okay, which will probably be in the other phase where they get clocked after they go through that, that Roman candle period, like Microsoft or Cisco's an example. But leave yourself more latitude, depending on the business, because they are unpredictable. Like, I got hammered. I was in Europe for I went to 40 meetings in 8 days, with different investors. We have another mutual fund. It's actually a UCITS fund in Europe, and some people approached us, and it's only been in existence a year, and so what in effect is we manage the money, they market it, and handle all the back office functions. But anyway, the question kept coming up about RIM, and because we have 70 basis points invested in RIM. I mean, it's like a peanut to me. But the reason we have 70 basis points in it is because we can't predict RIM. I mean, it's cheap, and it's one of those deals where the outcome is so wide that we just rather than taking a big position in it, we just said, when you have those kind of situations, what you do is you take several small positions. In effect, that's how you're hedging your bet. But in that case, and that comes back to the comment about loss of money, we're trying to minimize that kind of thing happening. But here's a case where you can have anywhere from probably 100% gain to total loss almost. I mean, look what's happened with Nokia, although their RIM is different than Nokia because they have software parts as well as the hardware parts. But I mean, it's just much more difficult. And so we try to adjust the best we can, taking that into account, probability wise. But, and ultimately, you know, they actually taught this at Harvard Business School when I was there, but it was, the idea was you went through these decision trees and you had fan outcomes, and then you'd attach probabilities to those outcomes, and that way you'd try to end up hitting it to where you, in effect, shifted the odds in your favor and making, this was in capital allocation type decisions, but it's the same thing, that's all we're doing all day. We're trying to go above our cost of capital, and when we can do it, and we feel comfortable with it, we'll make the investment. If not, we don't. So it's a lot of basic finance understanding. Which reminds me of a great accounting story. You've probably heard that this guy was an accountant, and every day he went in and he opened his drawer, closed it, and then went on with his work. And finally somebody asked him what it was. And he said, well, he opened the drawer and it said, debits on the left, credits on the right. Okay, any other questions? Yes?
Since we were talking about technology companies, that's how my question relates as well.
Can you speak up a little bit?
I was looking at some holdings in your portfolio, and I came across the fact that you purchased over 1 million shares of Dell in 2008. You decided to sell them, I think, in the second quarter of this year. And as a value investor, the goal is to invest for a long-term position of over 10 years or so, as you stated in many interviews. So my question is, what was the reason or rationality behind selling such a company as Dell?
Why did we
Just
make
after,
it?
just
What?
after 3 years.
The whole investment piece. Well, Dell got really cheap. There were some value investors that were buying Dell in the high 20s, I remember. And we looked at Dell, and Microsoft makes more money when Dell sells a computer than Dell does. That trade us a little bit more about Microsoft. And they have a much larger market share. Problem with the Dell is basically it's an assembler. And there are a lot of products in this world that are assembled where the component manufacturers actually make more money. We have a little bit invested in Intel, but very small. But the component people make much more money than the assemblers do. It's a low margin, very competitive business. And it is gradually being shaken out. You can see that Hewlett and Dell now are there, but we never had a big investment in Dell. It just got cheap enough that we ventured in, and when it got up there, we just found alternative uses for the cash, and we made some money, but not a lot. But it was never really an exciting, thrilling investment. So, and like with Hewlett, I mean, I think here's the dilemma that like a Hewlett has, because they have the biggest market share. They've tried to sell themselves as a total component company, in other words, a total package. Well, if you take out the computers, now you've totally changed your whole business strategy. And so the question is are you better off, even though it's a low return on asset business, that assembly business, to keep it in there so that you can sell the other parts of the business? Gradually, we're going to move away from desktop computers, in my opinion. I think they're probably on their way. I mean, it's going to be a gradual fade, but we're moving toward smaller and more portability in computing devices. And I mean, look, I'm a tech dinosaur compared to you guys. I do have one of these things that we ended up getting a lot of our family members the new Apple. But anyway, yeah, I'm not quite prepared to go to this to do all my computing or an iPad. But I do think, you know, certainly like when I went to Europe, I had a laptop with me the whole trip, and I had a Magic Jack. So I mean, I do a few things at least. I'm not totally dead yet. But as far as you know, most of you guys can run circles around me when it comes to the technology stuff. You know that there's an adage that if you have trouble with your computer, you ask your 16-year-old to help you. And if he can't help you, then you ask your 11-year-old. Okay, I'll tell you what, I will stay for another as much as 10 minutes and answer the questions. And I have to tell you one other story so you can really understand what business is all about. And then I'll finish up with any questions you have. This fellow went to the 25th class reunion at the Harvard Business School. And they said, Joe, we haven't seen you for 25 years. Where have you been? And he said, I barely got in here. He said, I worked my tail off for 2 years, and I barely graduated. He says, I knew I couldn't compete with you and your fancy jobs in consulting and finance in Boston, New York. He said, I went back to Illinois, a little town I came from. And he says, we did develop this little product and managed to patent it. He says, you guys use it every day. He says, we make it for $1 and we sell it for $4. He said, you would be amazed how that 3% adds up. You got it right. His math was in law. Okay, coming back, we got a question. I want to make sure. Go ahead. Yeah.
Okay, so also according to your portfolio, you have a large holdings on gas and oil industry, like such as Exxon and
Chevron.
yeah.
Conoco. Yeah.
Could you elaborate more? How do you evaluate this industry in terms of profitability?
How do we?
How do you basically evaluate this industry, like in terms of profitability? Because it's oil industry, and how do you?
To be honest with you, that's a little bit of a hedge. We justified the return. We bought the Conoco first. It was much cheaper than the ones in the industry, and it moved relative to Exxon, moved about 20%. We said at that price, if we thought them cheap enough, we'd add a little to Exxon. We're not excited. It's kind of one of those, when you see some of these small holdings, and Conoco has drifted. At one time, it was a big holding, and it's drifted and continued to slide as far as percentage holding. So I'm not enamored with the oil industry. It's a lot of capital. It is a unique commodity in the sense that you've got this somewhat of a controlled commodity, and it is disposable. So there are some benefits of it relative to something like copper or something like that. But enamored with it, no, we're probably never going to own it as much as the S&P has or something like that. Yes, sir.
Question concerning desktop computers, and you said it looks like going forward things are going to be smaller or mobile. Isn't that problematic for Microsoft?
Well, except that they got to run it on something. And again, I'm not a techie. I'm not a techie whiz or anything, but I would think that Windows has, and people are so used to using Windows of some kind. Yes, if you had some amazing leapfrog, and that's where technology really gets hammered. Look what's happened in photography. As you went from film photography to digital photography. Or you go to the internet and, we had an investment, we got hammered on that one. There was a little company called Franklin Covey, and you went to basically a machine that would do your time management, as opposed to writing it out on a time management paper. So yes, there are some of those, but I think in the case of Microsoft, even Microsoft and Jobs and Gates, kind of had an edgy relationship, but they had to have a relationship. So I think it's going to be hard to wipe out Microsoft. Very hard. And they have like 5 different major business units. They should really split that company up, by the way. They think they'd be better off. This is one case. If you don't get synergy, people have talked about trying to split up Pepsi, but I don't see the synergies. I see the synergies in Pepsi, and so I'm thinking to myself, what's the real advantage of splitting off carbonated beverages, just so in the very short term you can maybe get more value out of the company? But synergistically, those things do fit. They really do. Vending machines and grocery stores and people sitting in front of the TV, on and on. But Microsoft, I guess you could maybe say some of those things they have, but they got the games and all the other stuff that are out there in big pieces. And sometimes I think they just make so much money, some of these companies, they go out and they just want a kingdom built, they just keep buying pieces. The other thing that eventually happens is after they diversify, they eventually get religion and start to slim back too. I've seen that happen. One of the best case studies of I think, running a company was when Bill Sturritz ran Ralston Purina. And in the America had tax laws, or not tax laws, but FTC laws that, regarding market share, and they would let acquisitions occur. And a lot of these companies really diversified 30, 40 years ago. I mean, Ralston owned things like, now it's part of Nestle, but I mean, at one time, when it was a public company, they had ski resorts, and they had mushrooms, and they had Jack in the Box, and on and on. I mean, they had all these disparate pieces, and cereal, and as well as dog and cat food. Well, Sturritz basically slimmed it down to its most profitable core, which was dog and cat food. They bought back stock, and the stock did terrific. And I think a lot of times it'd be very easy to come in and do that with a lot of these companies that have become oversized and so on. But the other side is don't just throw them away. I mean, like with Hewlett Packard, sometimes you can have a runoff business and it's better because sometimes companies, new managements come in, they just want to get rid of it, and unfortunately, they get rid of it in a very uneconomic way. They sell it, they have to pay taxes, or they give it away at a low price, and on and on. I don't mind if they spin it off, and separate it out if it doesn't make synergy and it makes sense for the shareholder. But to do it another way, a lot of times it's poor execution. Again, it comes down to, I think ultimately this business, a lot of it's learning how business functions and what makes it tick. And you have to get some of that with experience, I guess. Yes, sir.
I was wondering if you would tell
me. Sorry.
I was wondering if you would tell us a little bit about whether there are other proxy issues besides the options compensation thing on which you often vote against management's recommendation or the board's recommendation.
Well, we tend to rely on Glass Lewis for a lot of the stuff. That's a proxy service that we use. Probably the only other consistent one that I see is on the advisory on compensation, and do it once. We do it on a yearly basis. Those two things we do. A lot of times management's opposed that. Right. The other one is, although in a way I feel like a hypocrite on this one because I'm the chairman of our mutual fund board.
Good. That's the next one I was going to ask you.
And that's the separation of the chairman. But the problem, I think, is the board members, I mean, it's frankly, in a mutual fund business, and please don't say this outside the room, I love our directors. They're great directors, and I've known these men for years. The problem is, in the mutual fund business, if you have outside auditors, a custodian, and an outside administrator, and a CCO, Chief Compliance Officer, the directors really don't have a job to do some really, and we'd be better off as a society. The SEC loves regulation. They love, they can find every place I didn't dot an I or cross a T, but they can't find Bernie Madoff. I mean, it just blows me away. I mean, these guys are just unbelievably minutia oriented. But anyway, so the director thing, I think at a corporate level, there is the case because we want some representation for the shareholders. We need to get back to that idea. The shareholders run it. What my fear is, I say that on one side, but my fear is that in some cases, groups of ownership through like a pension or like a union, for instance, won't vote in the best interest of the shareholders. They'll vote in the best interest of the union because they're a political body as opposed to a shareholder money-making body. And that's what bothers me on some of these issues. But I do think that some of them, we are gradually, I think, starting to recognize that. One of the great things of democracy is that free speech, you can't push things under the carpet. It allows you to gripe and make a fool of yourself too. But eventually we have to deal with the things that keep coming up. And I think that's a very healthy thing. Yeah. One more question, and then that's it. Okay. One Any other questions? Did we answer all of yours? Love to please the ladies. Well, listen, you've been an excellent audience, and this is my first time in Seguin, and so I'm glad to be down here. I wish all of you well in your education. One of the things that I'll leave you with, and that is that, and that's probably something you already know, but we are in a world environment where education becomes very important if it becomes useful education. So find something that's useful, and we did tell our kids as they grew up, we don't care what you do, but look in the mirror and then be the best at it you can be. So Mondays should be fun. If Mondays aren't fun for you, then think about where you're at as far as when you get to your jobs. Okay? Mondays should be fun. Mondays are still fun for me, and that's why I still come to work. Okay? I mean, one of the other reasons is, I remember Ralph Weinger, when he had his retirement party, his wife said, "And married you for better or worse, but not for lunch, Ralph." So, my dear wife and I have been married 46 years, and she keeps saying, "Why don't you get a hobby?" I said, "Dear, I do it all day." So, see, if you can get to the point in life where you can do that and have a skill that has some value to it, then I think your life will be fun. And I think America is a great place for people that have skills and inertia, what I call the 3 I's, integrity, intelligence, and intensity. You have that, I think it'll be a great place. Where I think it's a problem, and I don't know, politically it's a real big issue, is what do we do with all the rest? The people that are underclassed. In some cases, they're there just because I have a daughter who's a quadriplegic, for instance. She had a stroke at age 30, and clearly somebody like that has to be taken care of. But there are a lot of others who are taken care of that probably really need to get a boot in the backside. And it's not a fun place for a lot of us. So I hope you can be in that position for the rest of your lives, that you have a fun position to be in and enjoy Monday mornings. Thanks again.
Thank you for having us tonight and sharing your time and your talent. And in honor of you coming down next semester, the first Donald Yacktman Scholarship is going to be awarded to one of the top performers in Bulldog Investment Company. Wow. So thank you very much for sharing your time and talent. Go enjoy your grandkids' birthdays. Thanks.
Students at TLU engage in high-impact educational experiences that include civic engagement, aesthetic expression, critical thinking, and a focus on intercultural knowledge in a community that welcomes the interplay of faith and reason.